Investing is often seen as a numbers game, but in reality, our financial decisions are deeply influenced by psychology and emotion. Even the most experienced investors can fall prey to emotional biases that impact their judgment, leading to costly mistakes or missed opportunities. One of the most common emotions in investing is fear. When markets become volatile, fear can drive people to sell their investments at the worst possible time, locking in losses rather than riding out temporary downturns. This behavior is rooted in loss aversion, a psychological principle where the pain of losing is felt more intensely than the pleasure of gaining. As a result, investors may act impulsively, prioritizing short term relief over long term gains. Greed is another powerful force. In booming markets, the prospect of quick profits can lead to overconfidence and excessive risk taking. This is often seen in speculative bubbles, where investors chase rising prices without regard for underlying value. The fear of missing out, FOMO, can push people to invest in assets they don't fully understand, simply because others are profiting. Herd mentality also plays a significant role. People tend to follow the crowd, assuming that if everyone else is investing in a certain stock or sector, it must be a good idea. This collective behavior can inflate prices beyond reasonable levels, eventually resulting in sharp corrections when reality sets in. Confirmation bias further complicates matters. Investors often seek information that supports their existing beliefs and ignore evidence to the contrary. This can reinforce poor decision making and prevent objective analysis. To counter these emotional pitfalls, it's essential to have a clear investment plan and stick to it, regardless of market fluctuations. Diversifying your portfolio, setting realistic goals, and periodically reviewing your strategy can help reduce emotional reactions. Additionally, taking a long term perspective and focusing on fundamentals rather than short term noise can lead to better outcomes. Understanding the psychological factors at play allows investors to recognize their own biases and make more rational, informed decisions. By mastering the emotional side of investing, you can build greater confidence and resilience on your path to financial success.